All right, welcome back to another episode of Forward Guidance. And joining me today is Mel Mattison, who's an author, investor, fintech executive. He was on the show a couple times back when Jack Farley was running this joint, and it's been wildly overdue to get him on under my hosting of Forward Guidance now. So, yeah, Mel, it's great to have you on the show. How you been?
I've been doing great, and it's great to be here on with you, Felix. There's definitely been some events transpiring since my last appearance.
Yeah, to say the least. So, in the preparation of this interview, I went back and listened to you're on a podcast about I think just over a month ago, and you're making some pretty bold calls about expecting a 15 to 20% major market correction that was largely derived through what you characterize, I believe, as Trump, front loading a lot of pain first, and for some good things to come later on. And that's happened. And I've noticed now that you're actually also wildly bullish. So first off, I want to give you props on that call. It's not easy to make such a meaningful call with a time frame and a specific price target, and all for that to resolve within a month. So props for that. So I want to have you walk us through how you were thinking about things back then. How did they transpire, and then what has made you do the main flip into being a bullish bias now?
Yeah, well, I appreciate that, and I think you need to be humble in this business because crazy stuff happens. But I would point out it's not like I was making that 15-20% correction call like 2 weeks ago. I was making it in December and January. So coming into the year, I mean, I just saw everybody so bullish. Like everybody's like, oh, Trump's going to initiate, he's going to wave a magic wand and we're going to have low inflation. We're going to have deregulation. We're going to have amazing M&A activity. And then I combine that with like a fundamental understanding of like, wow, equities are overpriced. And so in December and January, I was like, look, we probably need to correct 15-20% correction down to 5150 was my call in December. We got a little bit below that. I said 5150, maybe lower in the first half. And then from there, we're going to bounce up and we're going to have a nice year. It's going to be a plus 15% year and close out somewhere around 7,000 on the S&P. And I have not drifted from that premise one bit from 3 or 4 months ago. So far, fingers crossed, like what I was doing back then, I was selling equities, I was raising cash, I was buying puts when vol was 14, I was buying gold, and I was saying, hey, we're going to sell off and then get ready to back up the truck because we're heading into an inflationary boom. And I think that's the point that we're at right now. So what I see happening and what I saw back then was number one, regardless of the flip out about tariffs, which I really think is more of a catalyst to correct really overpriced valuations and also really over US allocated global portfolios. So we came into the year with everybody US exceptionalism, like, massive amounts of total global equity value in US stocks, Mag 7 stocks. I mean, if you look right now as we're recording this, I mean, the Dow is down less than 5% year to date. The equal weight, I think, is down 5 or 6% year to date. So there has not been any big sell-off in Europe is up, DAX is up, emerging markets are flat. So if you look at global equities, like from the beginning of the year, they're basically flat or up, except for like big cap tech, all that stuff. But because they've been so much a part of these indexes, and so this pullback, my expectation was like 5150, which was like the August lows. I'm like, we'll get down to 5150, maybe 4800, which is the 20 January 2022 high. Like that just makes sense totally from a valuation perspective. Nothing to do with tariffs, nothing to do with anything else. We're due for something like this. So to see that happen makes total sense. And what I see now and what I think everybody's flipping out about, like, oh, well, the dollar's down. Yeah, you know why? Because there's global portfolios that are way over allocated to US that need to go into Europe, emerging markets, which was one of my also 2025 predictions I made in December, which was EEM outperforms SPY. Nobody saw that coming. Well, maybe some people did. I don't want to get too cocky, but I'm like, look, U.S. is everybody's talking U.S. exceptionalism. Like, let's pull U.S. equities in. Let's take a breather. Let's take a break. Let's reallocate around the world. And then, I believe we're going higher, and I believe it's based off like a 3 scenario case. Like, there's like a what I would call a best case scenario, a less than best, and then a worst case. And I think the first two are probably like 80% probabilities of happening, and they're inflationary, and I think they're positive equities, more positive gold, more positive Bitcoin, more positive, rest of world. And then, I think that bear case scenario is kind of like a depression collapse scenario, which I don't want to discount as zero, but I think it's very, very unlikely. And I think the most likely result is going to be another inflationary bubble that's just getting started. And, we can get into the details of all of it and why I think that's going to happen. But I mean, that's basically where I've been at and where I'm seeing things going.
Cool. Yeah, I would love for you to walk me through the key macro drivers that were occurring during this hiccup market crash moment that we've seen recently, because it's, yes, stocks are expensive, but in my opinion, just shorting because of that is a losing game. Like, you need some sort of catalyst to occur, because they can just get more expensive. It's a highly reflexive dynamic. So yes, it provided the environment to see such pullback because they were expensive. I don't think anybody would argue with that, but I'm curious, like bring us up to speed on how you were thinking about the fiscal dynamics and the monetary policy dynamics and even the liquidity dynamics. Like, where was the cross currents of all three of those? And how are you thinking? Have they shifted now? Is that providing further tailwind to your bull bias? Is it because you're a fader of the Doge idea and fiscal deficits will still keep increasing? Where's the Fed at? Like, what were these key macro drivers throughout this process?
Yeah, definitely. And I also want to admit, like, I got faked out too, because I was buying puts and thinking like we're overvalued, ready for a pullback in December and January. And then I started seeing the deep seek, and we had that drawdown in January. And actually some of the puts that I had bought, at the beginning of the year, I pulled out of as we went to new highs in February. Otherwise, I literally would have had like the most amazing year ever. I've been having a great year so far, but I was like, okay, I need to pull back from some of my short positions. Like, maybe this isn't happening. So, this is tricky markets, right? I mean, nobody has a crystal ball and plays it perfectly. And when you're managing positions and you're moving things around and you're doing things, I mean, look, sometimes you make mistakes. But my general call, which was like pulling cash, go long gold, buy some puts, do that. Like, so far it's been working out so good. If I'd have just kind of stuck to my guns through that February rally, I'd have, just nailed it even beyond my wildest dreams. But I still have been doing very well this year, and I'm up. But I mean, I think the macro drivers really is just taking a step back from the narrative that there's this preoccupation with Donald Trump, that he has this amazing way of pulling global leaders, investors, I mean, you name it, into his like, apprentice reality TV world. And like, you need to take a step back from that, and you need to think about what are the real long-term strategic interests of the different parties involved, and what makes sense as an outcome. Because if you just try to trade off of every headline and every tweet, I think you're losing that. And so while people were kind of going nuts about these tariffs, I was looking at it and saying, there's no way. Okay, two things. Number one, there's no way Doge is cutting 1 or 2 trillion from the budget. You had Howard Lutnick out there talking about balanced budgets. Give me a break. I do so much budget analysis every time. And it was just last week, the monthly Treasury statement comes out, and you look at outlays and government spending and where we're at. And it's like, government spending is up, deficits are up. Like, there's no, and the fiscal impulse is huge, right? So give some percentages. government spending as a percent of GDP, it's like 24%, right? Like it's like 7 trillion in like a $30 trillion economy, running $2 trillion in deficits. If we pulled back to balanced budgets with tax cuts and everything, we would be pulling like 3-4 trillion out of the US economy. That's disastrous. Investors were getting worried about that. I'm saying to myself, there's no way that's happening. Like it's just not realistic, because when you look at those figures, you look at Social Security, you look at entitlements, you look at veterans benefits, which are like political no touches, at least right now. I think eventually they need to be touched, but at least right now they're no touch. You look at interest on the debt. You look at these things, defense spending. Pete Hegseth and Trump just announced first ever $1 trillion defense budget. Like we're heading for blowout spending and blowout deficits. Like that's what the numbers say. And not only are we going to do that, but like we're doing that right now underneath the debt ceiling. I mean, this is perhaps like one of the most underreported stories I've ever heard. I follow the like I said, the MTS, the monthly treasury statement. Only $2 billion in new net issuance of treasuries last month. If you go back to like October, like we normally issue new net issuance is normally like $250 billion a month. And like it goes like October, November, it's like 200 billion to something. And then you go to like January, and these are on my Twitter feeds, but it's like, then you go to January, February, March, and it's like we've issued no new debt because of the debt ceiling. We're drawing down the TGA. We're going to get bailed out and be able to draw down the TGA a little bit more because it's April 15th as we record this tax
We
day.
get the taxes, yeah.
So we're going to get the taxes in, and that's going to give us a very little time. And then there's going to be a massive need to issue debt. And so where are we heading towards? What are we heading towards? We're heading towards massive spending, massive debt issuance, essentially status quo, which is inflationary, which does not necessarily mean a strong economy. It doesn't necessarily mean real growth. And I think during the Biden administration, we basically had no real growth. I think CPI numbers are BS. And if you look at like, CPI numbers and you add like 2 or 3% to it, that takes away all your real GDP growth. So what we've been doing is we've been growing nominal GDP. Nominal GDP has been growing. There's been very little real growth in the US economy for years. And I think that's only going to continue. I think there's a path forward. We can get into all of this of how this is happening. But here's the thing. Equity earnings are priced in nominal numbers, right? So, and then now you've got a deflating dollar. What's that going to do to overseas revenues, right? Like 50% of S&P revenues are overseas. Yes, tariffs and everything's going to affect that. So you're going to have nominal GDP growth, perhaps not real growth, but nominal due to inflation. You're going to have a depreciating dollar. It's going to jack up earnings growth. And, equity prices should go up. In real terms, no. In gold terms, no. In nominal terms, yes. And what have we been seeing? Equities are going up in nominal terms, and they've been going down in gold terms.
What stablecoins did for the US dollar, Ondo is doing for stocks, bonds, and more. They're making real-world assets accessible on-chain, laying the foundation for the next wave of financial innovation. With tokenization, Ondo Finance is transforming how financial assets are owned and traded. Discover how Ondo is revolutionizing capital markets at ondo.finance. That's ondo.finance. Restrictions apply. Mel, what I find really interesting is I've seen a theme over the last, basically since 2022, where guys like you that dig into the Treasury data have been on the right side of the economy. People that have been continued to adopt this idea of looking at, what is the Fed doing? What is monetary policy doing on the short rate? Which, nobody even really borrows that much on the short rate. Like it's been really interesting to see that folks like you that have been on the side of like digging into the Treasury data and saying, hey, look, we're actually, not only is Doge doing nothing, but there's a pretty clear pathway to even further increase deficits. And then you bring into the fold what we're starting to hear from the Treasury now in terms of policy. I saw you tweeting about this yesterday too. We had a Scott Besson interview where he was talking about, what are some of the tools that are available if the long bond starts to get more unruly. And, there's this idea of Treasury buybacks where often what they'll do is, typically historically it's duration matched, where they'll basically buy off their own bonds that are illiquid and just swap them with on their own bonds, but the duration is the same. But if they started to shift towards issuing bills to fund those off their own bonds on the long bond, that starts to get really interesting. And then you see furthermore, the first QRA meeting that we had with Treasury Secretary Scott Bessent, he basically kept the same guidance towards a preference for bills issuance. So starting to put all these together, are you of the mind that we're just going back to how things were at the start of 2022? And if so, are a lot of people offside here thinking about depression and recession? Because if we're just going to blow up nominal GDP growth, like it seems like we might be going through the repeat of this.
Yeah, that's what I think. That's why we get to 7,000 or thereabouts. Call it in by the end of the year. Maybe I'm off on that. I'm not perfect. Like maybe it takes 12 or 18 months to get there. But yeah, I mean, that's why I think that's where we go. But is that going to be real S&P growth, or is that going to be nominal growth? But I think for investors, it's important to take a step back and say, how do equity markets work? How are they priced? And I think the gold market is telling you this. I mean, like I keep waiting for a pullback in gold. I do a lot of gold work. I sent a chart over on some Fibonacci numbers, like 32, 38 on futures, which is basically where we're trading as we're recording this, is a key level. Was expecting a pullback, as we hit this, and like at least as we're recording this, we're not seeing it, and what we're seeing is like gold like march higher. And when we do get pullbacks in gold, it's like it happens in like an hour. Like it drops 50, 60 bucks in an hour, and then an hour later so it's testing the key levels that I watch, but it's not testing them for days or even hours. It's like testing them for like minutes, and then it's moving higher. And so like to me, I mean, 1971, right? Gold is $35 an ounce. 11 years later, it's over 800. That's a 25x increase in gold. A 25x increase in gold from where we were a couple years ago, like let's call it 2000, that's $50,000 gold. Do I think we're going to $50,000 gold in the next 10 years? Honestly, maybe. I think twice in history, the gold price has been higher than the Dow. I think you got to go back to the Depression, I think it was. And I think it happened like one other time where literally 1 ounce of gold, the dollar amount was higher than the Dow. We're at a Dow 41,000 right now. So I think that's kind of ridiculous, like $50,000 gold in 10 years. I think it's possible. But even if that's completely way off base, let's just say I'm way off base on that, and that's absolutely ridiculous. $10,000 gold, that's pretty amazing. That's like a 2-3x move from here over the next 10 years. And to me, like that is the world that we're heading into. And we're heading into that world because there is no way to get ourselves out of this other than Great Depression, economic collapse, or inflation. I mean, we can get into the details of what that means, but I honestly believe that policymakers will eventually think all this through, as I've been doing for years and years, and realize that there's only two choices. It's, do you want to collapse the economy and maintain the value of your currency, or do you want to inflate it away? And to be clear, one of the things I said in the outline is, why does this work? Because it's not just the U.S. This is a global phenomenon. Italy has higher debt to GDP than the U.S. Japan has higher debt to GDP than the U.S. Spain has higher debt to GDP than the U.S. France, like we can go on and on and on about these. This is a sovereign debt bubble, and you can only get through it one of two ways. You can let it all collapse and let the system blow up, which is going to be absolutely 1929 all over again, or you can inflate it away. But, and this is key, and I also sent over a note of an IMF paper about how the U.S. got out of GDP to deficits in 1920. So this is a really good IMF paper. It was looking back. It said, did the US really grow itself out of its World War II debt? And it went back, it analyzed the situation, and it did all this statistical stuff and all this IMF, PhD, regression type stuff. And basically, at the end of the day, they said, no, they didn't grow themselves out. They inflated their ways out through surprise inflation. And surprise is the key word. And, yield curve manipulation. And I think that's what's coming. Surprise inflation. They're going to try to talk down inflation. It's not coming. Fed is resolute. We're going to keep a lid on it. But I think when like Besson and Powell have their breakfast and all this stuff happens, like they're gonna be like, okay, look, we're between a rock and a hard place, and the best out is sustained, substantial surprise inflation. Like I'm talking 5-6% annualized for the next 3 to 7 years. I'm not talking about hyperinflation or 10% or the dollar is going to become, the Zimbabwe currency or whatever. Or like that. That's not what I'm talking about. But what I'm talking about is that we're going to have and that's what the bond market is sniffing out. And that's why yields keep going up, because they're saying, look, the bond market is the one who gets killed in this scenario. What does well? Equities, especially, more than equities, gold and Bitcoin. And, I think real estate ultimately will do well as well. Basically, anything priced in dollar terms does well. It's all the same trade, anti-dollar trade, uh, long assets, short bonds.
Yeah, Mel, I want to ask you. So it feels like the narrative, as everybody's trying to figure out what's been going on, what's been driving yields higher, what's been driving gold higher. And I've seen some takes where it's a losing of faith in the US dollar, in the institutions in the US, catalyzed by this global trade war that we're going for. So are you saying that rather it's just the reflection of the market keying into the fact that nothing has actually changed and we're about to go through the next upswing, cyclical upswing in inflation, and that is being reflected in the gold price, that is being reflected in higher bond yields?
Exactly. I mean, I don't usually, when I go on podcasts, like I wrote a book. It's called Quaz. It's a financial thriller, and it's basically like a fictional narrative of a financial collapse, and it involves a lot of intrigue and corrupt central bankers. And there's a guy named Hao Zong who's like the head of the People's Bank of China, and he starts selling, U.S. Treasury holdings into the market, and there's a market collapse, and everybody starts flipping out in the book because unlike in other collapses, the dollar's not going up and bond yields are going up. And it's like, that's literally like the climax of the book. I don't want to give too much away if people want to buy it. But look, so I understand these dynamics. I mean, I wrote that book in 2020, 2 years ago, and then people talking about all this stuff happening now. But basically, I've thought through this so much for so long. I mean, like, I think the first time I came on Forward Guidance with Jack, like I was talking like, this is where I think the title of it was Final Straw in the US Dollar Debt Spiral. And I was talking like, we are in an unsustainable path. Like people need to realize like this cannot go on. And I talked about a 2027, 2028 time frame for when what hits the fan, because that happens to coincide with like Social Security. And in Social Security, that cannot be understated. The Social Security impact of what's happening with Medicare and Social Security, because we literally, and I go through the Treasury data, the Social Security data, the CBO data. Like we literally peaked in the Social Security Trust Fund in like 2020, and we started drawing that down. That has a couple of effects. Number one, if you look at like total government debt, like 37 trillion, a lot of it is intergovernmental. And you know where it is? It's to the Social Security Trust Fund. We were growing the Social Security Trust Fund basically from the 80s until 2020 because, more was being paid in than we were paying out. We started drawing that down in 2020. We're now drawing down the Social Security Trust Fund, which is actually a reduction of Treasury expenses because so the Social Security Trust Fund, for those that don't know, it is invested in a unique type of treasury bond, a non-public treasury bond. It's basically a bond that the Treasury issues that only the Social Security Trust Fund can buy, and they get an interest rate on that. And that goes into government accounting and deficits and everything. As the Social Security Trust Fund gets drawn down, that actually means the Treasury has less interest to pay to the Social Security Trust Fund. So it's actually like bullish on US government accounting. But in reality, what's happening is we're going to head to zero around the end of this decade on the Social Security Trust Fund. And at that point, like it's a cliff. And a couple things to remember. Number one, Social Security can only be paid for by paid in Social Security according to law, which is
So
different
they
than
can't
Medicare.
monetize, like the Fed
No,
can't monetize it. Okay.
no, and the Treasury can't just say we're gonna pay it, and like it needs a congressional action to change it, which is different than Medicare. And so all this stuff is going on, and I'm looking at all of this stuff. I really, for people that don't know me, so I've worked 25 years in financial services, graduated college in the late 90s. I know I don't look it. I'm a young, handsome guy. I actually turned 50 years old this year. But I've been through some markets, right? I've been through the .com. I've been through GFC. I've been through this, and I was sitting at home during the pandemic, and I started like getting into this, and I started looking at the expansion of the Fed balance sheet, and I started saying, look, pre GFC we're like an $800 billion Fed balance sheet. Post GFC, okay, we're up to a couple trillion. Pandemic happens, we go up to 9 trillion. I'm like, this is, and I'm like, what are these obligations? I'm like, what really are they? Not like I know they're big. Let me actually go to the websites, go to the documents, research it, figure out what's really going on here. And I'm like, we're heading for trouble, man. I mean,
Yeah.
there's no easy way out of this, and so there really is a big problem that's occurring here, and that goes back to my, there's three scenarios. There's a scenario where we start to address it and we get through it. There's a scenario where we don't address it, and I think we still have a few years of this inflationary stuff. And then there's a scenario where we just, don't address it or try to do austerity or something like that, and then we collapse. But I think both of those first two are bullish equities in the short term. One of them is bullish equities long term. The other one is actually uber bearish in the medium term, which is like a 2027, 2028, 60, 70, 80% equity collapse. So I don't know which direction we're going to go, but I think those first two all point to we still need to inflate. We still got some balance sheet room. The entitlements aren't coming due yet. We've got a few years on that. And what we need to do is we need to spend, 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 but at the same time, put in a way out of this mess during this short window that we have. And, we will see what happens. But as long as those first two occur, at least for the time being, we're positive. In a year, I'll look back and say, okay, did we just brush it off and then I see a big collapse coming? Or did we actually make some movement on the manufacturing needs of national defense, on addressing the budget deficits, stuff that goes back to Triffin's dilemma, Bretton Woods, all that stuff? Like, did we actually make some headway on that can be fixed over the next 10 to 12 years? Or did we just push it off, in which case we're really heading for trouble? So that's where I see things at right now.
It feels to me like we're starting to craft this theme that nothing, the tangibles that got us to this point, none of them are actively changing as much as the narrative might be in the mainstream, which is obviously the restructuring of the global trade order, the attempt to wrangle in fiscal largesse, and it's if you dig into the data like you have, it's obviously that we're still running a higher deficit than we did last year. There's fiscal bills, especially in the Senate side, that look at increasing deficits quite substantially. There's talk of obviously extending the existing tax cuts, but then even adding further tax cuts onto that. And then you bring forth the interplay of tariffs, and what's going on there is, the idea is that, or at least how they're pitching it, is that tariffs will bridge the gap of that missing revenue from the tax cuts. But then it's like, okay, well, we've seen, obviously on Liberation Day, we got to what is the worst outcome, which is the 30% effective tariff rate. we've seen this continuous ratcheting down so far, where we have some exemptions, we have a 90-day pause. We're roughly, the last data I've seen is, we're roughly at like a 24% expected tariff rate now. Within that, a lot of it is between China and the US. And effectively, we're at a point where we basically have like a trade embargo between the two biggest countries of over 100% tariffs on each country. Just no trade's going to happen. So for your thesis to continue to play out, do you have to discount and fade the tariff narrative that it's just going to keep ratcheting downward and we're going to end up at maybe, I don't know, 10% or something like that? Or how do you think about the tail risk involved of what if these 100% tariffs on the two biggest world economies stay resilient?
Yeah. Well, I mean, we didn't get into what I see as like the Trump grand agenda. And I think in some way, like the plan is blowing up a little bit. But at the other
Yeah.
hand, I kind of see that, I've called it different things. I've called it fire ice. I've called it salsa sour cream. I've called it different things like, you know, there are hot components to the agenda and there are cool components. Tariffs are definitely like a cooling component on the economy, but there are some real hot components. There's some salsa components, right? We're getting a lot of sour cream right now, but the salsa, I think, is yet to come. And I think Trump is really pushing things because if he loses Congress because it's so tight, like he's not going to get those salsa components through. And I think this 90-day pause gives him that room and, get in a little, detailed stuff. So Mike Johnston, Speaker of the House, he was on, I think it was either Sunday Morning Futures or something like that this weekend with Maria Bartiromo. And he was talking like most people think the debt ceiling, because we're going to get a bunch of tax revenues this month, we're going to be able to go to July, August, September.
Yeah, I've heard
And he was saying, and he's like, but maybe not. Like maybe it's June. So to me, the 90-day interval is not random. Like Trump wants to get some of these salsa items passed during that 90 days to free him up on more of that tariff sour cream stuff later. So what we really need to see for this whole thesis and the bull market, like in the next 3 months, we need to see some of these salsa items really coming into fruition. We need to see massive tax cuts. We need to see no tax on Social Security, tips, overtime. The deregulation is ongoing. We've got this new guy, Pulte, in charge of the housing authority. I think that's where you tap the money, man. I mean, I look at IMF tables of like debt, and it's like everything is like debt going up. And then you look at U.S. households, it's just been going down. Like if you go back to 2007, like we're like 20-30% household debt reduction on a percentage basis in the United States. Where is all that money? It's in houses. It is in homes. We need to, like, I think Trump's going to be like, we need to find a way. And like, they hinted at some of this stuff under Biden, which was expanding Fannie Mae and Freddie Mac guarantees on second mortgages, right? So now you've got these people, they're sitting in houses at 2.8%. The equity value is enormous, like 13, 14 trillion, but they don't want to access it because if you go to do a HELOC, you're at like, 3%. Yeah, no, it's not even that. It's like 3-4% over like 10-year. It's like 8-9%, And
okay, yeah, I was thinking, yeah, okay.
Like if you go to a HELOC right now, you're not going to get 5 or 6%. You're going to be more like 7, 8, maybe 9. So get those things down. Like there's all these, and this is the thing. I mentioned this on Twitter to someone. I said one of the things that I think I'm a little different than some people is I actually give policymakers credit for being intelligent, creative, and powerful. And don't underestimate Treasury officials, central bankers. Don't underestimate what they can do. I've been watching people for so many years, guys like Peter Schiff out there. Every time the markets are going down, it's just the collapse. And then he comes out a few years later and he's like, Well, in 2008, I never imagined the Fed could blow up their balance sheet to $9 trillion. It's like, why not? Because you have no
That should be the
imagination.
baseline expectation.
Yeah, yeah, that should be the
Yeah,
baseline. Like, why can't the Fed blow up the balance sheet to 25 trillion? Why not? And
yeah.
people are going to say, oh, it's going to be inflation. Well, I would be a little bit careful on that because we blew up the balance sheet after GFC and we didn't get that huge inflation that everybody thought. I think there's a lot more room on the Federal Reserve balance sheet than people understand that is not even going to create hyperinflation. It might create this 4 or 5% inflation, which I think is actually beneficial to reduce the real value of debt to GDP. But I think like in 10 years, we could be sitting here with a $30 trillion Fed balance sheet, and people will say, well, the only reason we got through that whole crisis period was because I never anticipated that the Fed could get away with the 20 or $30 trillion balance sheet. And I would say, why not? Why didn't you anticipate that?
Tokenization isn't just a buzzword. It's the most efficient way to reimagine how financial assets are owned, traded, and managed. Ondo is bringing traditional assets like stocks and bonds on-chain, unlocking trillions in value and creating open global financial markets. They're not just dreaming big, they're building the platforms, assets, and infrastructure to make it happen. Head to ondo.finance, ONDO.FINANCE, and see how they're bringing capital markets on-chain. Restrictions apply. Yeah. So that dynamic where you just mentioned about the 2.8% mortgage rate versus the HELOC that sits at 8 or 9%. That when you say that, I start to think about what I've been hearing from Scott Bessent, which is that, and also President Trump, which is they want to get the long bond yield down. They want to get the 10-year yield down. That starts to make sense to me. But then you look at the reaction to the bond market throughout this whole dynamic, and we have yields, starting to get a little yippy, as President Trump said, and we're starting to hit those 5%. That's going in the wrong direction. So how do they deal with that? How do they not lose the bond market throughout this process?
Well, that's the problem, is because the bond market. Okay, so my primary way of looking at where the 10-year yield should be is looking at it, and I'll give some credit to George Robertson, who I went on a forum for. Like he
He's
nails
been on it.
this.
Yeah.
He's been on it, and it's funny because I'm generally a little bit pro Trump, and he's not, but like he's actually bullish now, and so am I, because he's looking like the fiscal spend still continuing, and he posted something from someone about like Trump is simulation 2.0, like the market's starting to look through Trump, like they're starting to see the facade or whatever. And that's kind of an anti-Trump thing. I could paint it with a positive thing. I think all that politics crap doesn't matter. All I want to do is make money. But what I'm talking about is, where I see things going. And even though, George and I might be on different sides of the political debate, we're still seeing things heading the same way, which is there's just no way to kind of unravel this thing in like a way that, I don't know, like this, like Lutnick. Like, I mean, that guy, I mean, he really should go. I mean, he comes out and talks about balanced budgets. Like, I mean, what
That
crack
would
are
be
you
depression.
smoking? No,
Yeah.
exactly. I mean, we pull in like less than $5 trillion a year in receipts. If we took and we spend over 7 trillion, if we took US government spending from like 7+ trillion to 4.8 trillion, I mean, what are you talking about? Like Besant is the guy that understands it, and that's why Besant. I mean, Besant to me. I mean, I listened to the Besant interview yesterday with Bloomberg. I mean, that's more important to me than listening to Trump or Ludnick or
Agreed.
Navarro. Like that. That's where you're getting the plan, and he spelled it out perfectly. He said, "Okay, we are going to get some." Not deals done, because trade deals take time, but we're going to have like agreements in principle, and that's what I think is coming. So he's going to say, we met with the Japan delegation, we need to work out the details, but we now have an agreement in principle with Japan, with the EU, with et cetera, et cetera. And then you start getting those things going. And then I thought this was huge, was he said that the Treasury has tons of tools, including the Treasury buyback program. So, we could talk about that for a second for people that don't know what that is, how it's been getting ramped up lately. So I could get into that a little bit about what the Treasury buyback program is and why that's important.
Yeah, I think it'd be good. I think it'd also be good to contextualize it by, yeah, just like what is like are, is some sort of external force needed to manage this bond market? Because to me, it feels like yields going higher goes against everything they're trying to do here. So I want to understand: do we need an external force like ramped up Treasury buybacks, especially ones where they fund it with bills and buy the long end? Like, do we need something like that? Do we need something from the Fed? Yeah, try to paint a
Yeah.
picture there.
Yeah. Oh, yeah. Yeah. Not to like hold the story. I totally believe in what I call YCD, which is not YCC, but yield curve distortion. That that they're going to, and they're already distorting the curve. I sent over a chart comparing 10-year yields to the 30-year mortgage rate and the spread. And again, this is a George Robertson thing where he's like, look, mortgages are MBS. They're guaranteed more or less by the federal government. Why has that spread blown out post COVID? And it's because there is distortions occurring in the curve. If you look at Treasury curve, it is now very different from what I would call in economic parlance the risk-free curve. The risk-free curve is much steeper and much higher than the Treasury curve right now because the Treasury curve is distorted. And so if you want to understand what's the real like 10-year rate, which is basically a basket of nominal GDP expectations, I would say you take a look at the mortgage back rate, which is 7.5 right now, like the highest we've seen in a long time. I think it's getting close to 7.5 or 7.3. I think you back out some cushion
Complexity
in.
and stuff. Yeah.
Well, you back out some cushion in there because you have to package the mortgages or whatever. Let's call it 100. Let's be generous. Let's call it 150 basis points. So you go 7.5 minus 150, you're at 6. And the reason why you're comparing a 30-year mortgage to a 10-year is because the duration is similar because of the prepayment risk that's inherent in mortgages. So you've got so you're really at, like, in my opinion, a 6% 10-year right now, a 6% 10-year risk-free rate. That's the market risk-free 10-year rate, which is telling you a basket of NGDP, nominal gross domestic product, over the next 10 years is going to be around 6%. Now, how much of that is going to be real growth? I don't know. 1%, 2%, 0%. How much of that is going to be, how much of that 6% is going to be inflation? I would say 6, 5, 4. So that's what I see the market pricing into the bond market. And that's why, okay, the Trump tariffs come off, US yields, go down 3.8 or not 3.8, but they declined by like 20, 30 basis points, and then they skyrocketed back up. Why? Market is realizing that inflation dynamic, that NGDP, nominal gross domestic product, is going to be like sensationally positive in the coming years because there's no way to get away from this inflation dynamic. And so that's driving up yields. Now, why did the dollar go down at the same time? Because look, I worked for multi-hundred-billion-dollar asset managers after I got my MBA from Duke. I would be in the rooms with people putting together portfolio allocations for things. We would have something we called a placemat. It was basically every asset class in the world, and it was looking at like correlations and expected returns. And you run it through a portfolio optimizer, and if you did that when I had graduated from business school, it basically told you invest everything into emerging market equities, because emerging market equities, in the 2000s had just been
Yeah.
off the hook, right? It was like
Yeah.
the expected vol was low, the expected return was super high. And what's happened in the last 10 years is that placemat made it look like invest everything in US tech. And global investors around the world got way, way over allocated to US tech. And we're seeing that trade unwind. And that's why in my 2025 predictions, I said EEM outperforms SPY, because I think people have been under allocated to EEM, FXI, EFA, global developed markets, ex-US, all of that stuff. And so what do they do in this situation? Okay, what just happened? Investors looking at it and they're saying, okay, we're going through an uncertainty period, but at the end of it, it's going to be inflationary. Do we want to hide out in the 10-year? Hell no. Because normally, if a recession is coming and the Fed's rushing in to cut rates, you know, 10-year is a great place to hide out because number one, it's US Treasury, it's quote risk free. Plus, yields should essentially, you should forecast yields to be coming down. So you're not only going to get that risk free comfort, you're going to get a kicker of rates coming down and price appreciation in the 10-year. Investors are saying that ain't happening this time. And that's why Buffett's not hanging out in the 10-year or the 5-year. He's hanging out in bills. And if you looked at it, what happened during this whole thing, it was a steepening of the yield curve. And isn't a steepening of the yield curve bullish?
Yeah. So, okay. So this is something I've been trying to figure out is within that dynamic of bond yields going higher, in break-even rates as measured by the market have not been going higher, but inflation expectation survey data has been going higher. So it's this really weird moment where real yields are soaring because the yields are going up, but then break-evens are staying flat. But then like survey data is going up. I've seen some smart, like Danny Dan, who's on the show a lot. He's talked about he thinks that the break-even market is all messed up right now. Are you of that mind as well?
Yeah, I mean, I'm not an expert in like the tips and the break even market. I do think though, even Powell in his last speech, like he literally pointed this out. He's like, there's soft sentiment data, there's hard data, there's market data, the sentiment data, and you know, we saw all this. We saw initially, if you broke it down by political party, the Democrats were forecasting high inflation, and people said, "Don't worry about the UMISH." And then they said, "Okay, now it's everybody." I think at the end of the day, it's sentiment survey data, and I honestly like. I trust more in like a stick of gum or something as far as inflate. I mean, inflation expectations from some random survey of consumers of what do they think inflate. Like I don't think that's anything to pay attention to. I think that the break evens and the tips markets are showing lower inflation rates. And I think there's there's partially a reason for that. And that's because I do think we're going to have a surprise decrease in inflation in the very short term. So that's something we haven't talked about. We just saw Canada inflation came out today, lower than expected. And I think the number one primary driver, real economy driver of inflation is oil. And I think that this is very deflationary. And so the tariffs haven't, and so I think we're going, and this is why I think there's going to be probably 100 basis points of rate cuts this year, is because we're going to have a surprise dip in inflation. So, and this dip in inflation, it's going to take away stagflation fears. It's going to make people feel comfortable. The Fed's going to come in and cut. We're going to get fiscal stimulus around the globe, and then inflation is going to start to ramp up, and that's the bullish case. Like I said, on the equities, and by the time the Fed is just going to be late again, wrong again. They're sitting here like, oh, they're like some of these Fed governors, like, this is not a time for any bold action. We need to be very careful. They were dropping rates by 50 basis points in a single meeting when inflation was much higher. I mean, it's out of control. And don't forget that in 12 months from now, we're going to get a new Fed chair. And I believe there's a whole nother layer to this, which we haven't even got into. I don't know if we have time to, which is of a monetary power grab by the
Yeah, I don't want to hear about
Treasury.
this. Yeah, because we haven't even talked really about the Fed action. You just mentioned 100 basis point cuts, but to your point, most of these dynamics have not been related to the Fed. So yeah, where does that
Yeah,
comes
I
into
think
place?
this is a neutering of the Fed. This is going back to 1940s. Fed as an instrument of the Treasury. Besant yesterday, he said, we didn't talk about it. So Treasury buybacks is just one little example of it, which is, every month or every quarter, there's a quarterly Treasury announcement. You can go there. I think the next one comes out first week of May. So we'll have a new one. They produce minutes of this committee. It's like people, it's like Treasury Secretary, it's, people from big banks, and they talk about things. And yesterday I went back and reread the minutes of the latest Treasury committee meeting, and what did they say about Treasury buyback program? And it was very vague. It's like a little paragraph, um, and it talks about like we could do this in different ways. We could expand it. And so the Treasury buyback period thing, ostensibly, the rationale for it is there are off the run treasuries, like weird issuances at weird rates. Therefore, they're not very liquid. And so, to create an orderly market, we as Treasury, we're going to go in and we're going to buy these kind of redhead stepchild treasury bonds and bring them back in the treasury to. And what Besant mentioned yesterday when he said toolkit was we have the Treasury buyback program. And it's like the whole idea of the Treasury buyback program is just to smooth out some of these really weird issuances. Now
It's
he's
not to change the duration itself.
yeah, it's not to affect monetary policy or be a financial stress toolkit, and so I think if you think like we're in a war, which I think we are, I think we're in an economic war. I think if it wasn't the nuclear age, we'd already be in a kinetic war with Russia, China, whatever. Then you need to go back to wartime thinking. You need to think like FDR. You need to think about, Treasury Fed dynamics the way they were in the 1940s, which was, okay, Fed, you're going to cap the 10-year at 2.5. You're going to put the short rate at 3/8. You're going to buy whatever we issue. Yield curve control. I mean, and so I think this stuff, maybe even capital controls, all this stuff, like I think this is coming down the pike because, as you mentioned, like you asked me, like, Mel, how do you reconcile everything you've just said with the bond market not going to a 8% 10-year? And you can't, but we can't go to an 8% 10-year. It's not
So something needs to,
1970.
yeah.
Man, yeah. We're not 35% debt to GDP like we were under Volcker, where we could handle a 7 or 8% 10-year. And so what you do is, and this is part of that IMF article, is it's not just inflation, it needs to be kind of surprise inflation. So you publicly just talk down inflation, nothing's going to happen. And then behind the scenes, you're doing all of these things to essentially manipulate things, more bill issuance, the expansion of the SLR, the strategic leverage ratio, so that treasuries essentially count 0% against it, so banks can absorb it. The Genius Act, the stablecoin bill, so that you start, you add all of these things to get the sovereign wealth fund is another, probably going to be a point of this. And so what you wind up getting is you get this stealth QE, stealth YCC or YCD, yield curve distortion. You get, and this is how you keep real, like the yields down, and basically you create negative real yields in the market, and negative real yields are bullish.
Okay, so in the last few minutes here, I would love for you to just rip through different asset classes with this perspective. And I would love for you to start with currencies, actually, because as you mentioned, there's this idea of the anti-dollar trade. And the way I'm going to set this up is that, okay, from 2022 till 6 months ago, we've mostly seen the US do outsized fiscal deficits. Their economies run hot, nominal GDP has run hot, equities have run hot, whereas every other country has not done nearly the same size as deficits. They've almost, if we just look at like Germany industrial production the last couple of years, it's just been in the weeds. It's just been awful. You could maybe argue as they were in a recession. Now we're getting to this point where, okay, if you're telling me through everything we just said that it's going to be the same as it ever was in the US in terms of high fiscal deficits, and because of the impact of either tariff, dynamics on these emerging market economies and even like developed like Europe, et cetera, if they're going to run higher fiscal deficits at the same time, that will run the economy hot, bond yields up, potentially equities up. So if you have that all happening in every country at the same time, that to me tells, lower currencies across the board. But if they're all going lower at the same time, you don't get the high Dixie like we've seen the last couple of years because it was just the US there. So yeah, take that and let me hear about how you think about currencies from here.
Yeah, well, I mean, the Dixie really, it's kind of, based on the major developed currencies, right? The biggest components are the dollar, euro, yen, franc, or whatever. I mean, I would be bullish, the Colombian peso. Like think about it. If you go to that IMF data tracker and you look which countries have low debt to GDP, it's, Colombia. It's Mexico, like 40%. Canada is not high. It's like 50%. Germany is like 50%. And then you go around, and then you start seeing, okay, it's actually a lot higher pretty much everywhere else. So I think actually emerging markets, which have not been discussed that much this year at all, and are basically flat on the year, um, are setting up for a potential massive run because of developed market massive currency devaluation, like generally across the board. And so, the problem with Germany is they're in the EU, right? So if they had their own currency, I would be like, oh, the German, mark is going to be extremely strong because they're like 45% debt to GDP, but they're in the Eurozone with Spain and Italy and France. And another country that has very high debt to GDP is UK, so the pound doesn't look good to me. So like when I think about what currencies would I be bullish on, I would look at, number one, debt to GDP, and say who's low, who can do balance sheet expansion without blowing out, these debt to GDP numbers. And most of those countries, with the exception, I would say, of basically Germany, are which doesn't have its own currency, are EEM. So, like I think in the EEM, and another part of this is that real assets go up, right? Because it's the anti-dollar trade, and that's very commodity bullish. And a lot of emerging markets are commodity markets, and so, like, to me, if you combine those commodity markets with potential for like EEM currency outperformance, I mean, you look at the EEM, and you think, wow, forget EFA, forget SPY. I want to be in emerging markets. Now, in financial tumult, because of different, dots that are connected, a lot of times investors get fearful of EEM. But let's say we get through like a tumultuous phase, the volatility dips a little bit, and then this path forward that I'm painting becomes clear. I think then you just, look out for emerging markets. So I think on a currency front, the dollar was like 120 at the end of the 90s. Another kind of US exceptionalism type period where everybody wanted to be in US equities. And I believe it got all the way down into the 70s. So I think the dollar could still have a way to go. It was one of my 2025 predictions was DXY ends the year under 100. I'm not saying we're getting to it, and the problem with the DXY is it's the yen, it's the euro. So you're valuing it against other developed market currencies. So I'm not saying it's going to 70, but I would just basically say emerging market currencies overdeveloped. Once this tumult period clears, seems to be a pretty good bet to me.
Yeah, and then you've obviously already characterized bullish equities, bearish bonds. I would love for you to just finish up here by just characterizing gold and Bitcoin, and how do you think about the interplay between the two asset classes?
I mean, those have been for a long time, like what I harp on, and different stuff. And I think gold has the track record. I think gold is also being bought by central banks, which is a huge shift. Like, can't be overstated. I mean, the Bank of England, all these central banks, they were selling gold after the US went off the gold standard. They were essentially flooding the market with supply. And now central banks are buying. And I think, gold is your kind of keystone. But I think, Bitcoin is in a process. I don't think it's there yet, but I think it's in a little bit of a process of decoupling from NASDAQ 100% correlation. And the reason why is, Bitcoin essentially, I mean, even by the US, I mean, it's under the CFTC, it's a commodity. Like, and so it's a supply demand type pricing structure. It's not based on earnings. It's not based on tariffs. It's not, and so I think what investors will do is they'll, and especially now that it's becoming more and more legitimized and regulatory things. I follow this pretty closely, and especially Cynthia Loomis, the Wyoming senator, which it's not a surprise she's from Wyoming, where there's a lot of state chartered banks and different things and trust companies, and she's big into promoting Bitcoin. But like, she's laid out a 3-step strategy, which is, the first thing we're going to do is we're going to get this, stable coin bill passed. It could be bipartisan. It's called the Genius Act. And then we're going to move into like regulatory clarity on cryptos. And then we're going to talk about like BTC and sovereign wealth fund and so on. So I'm generally, very bullish on gold and Bitcoin. And then after that, equities. Within equities, emerging markets, developed markets, ex-US, US markets. And then, going into, bonds is basically where I think, the price gets paid, is the real purchasing power of bonds, because of this yield curve distortion, yield curve control that's going to prohibit bonds from getting to where they really should get, which is 7-8%, and it's going to stop them from getting there, and that's where you don't want to be.
Nice. Mel, that was a fascinating conversation. Loved it a lot. Where can folks go if they want to see more of your work?
Mel Mattison 1 on Twitter. I don't have a lot of followers, even though I do a lot of good stuff. So I'd really appreciate it if people would go ahead and follow it. If they're interested in a fictional financial thriller, Quaz is available, audiobook, Kindle, everything, just search that. And that would be about it. But really, I just love coming out and expressing my views. So appreciate it, Felix. Thanks for having me.
Yeah, likewise. Enjoyed that a lot. Thanks again.